Coming up on this week's RegCast.
A few years ago, there was still a bit of doubt to say, is crypto going to survive? Is it going to go to zero? Is the technology safe? And now I think we passed that point. So people are more interested to know this is going to happen and how do I get involved in that?
And it's not immediately clear to us when we look at the specifics of how a DAO works that you can ever have a truly decentralized autonomous organization. If you're a software developer, you know that any kind of non-trivial code needs somebody to maintain it or it stops working.
Lots of different countries, each kind of going their own way. You've got the US executive order in the US, you've got the MiCA in Europe, and you've got consultation on stablecoins in the UK, right? There isn't yet a supranational body like the FSB or IOSCO equivalent for crypto assets. And this will result in a quite challenging patchwork quilt of regulation in crypto if we're not careful.
So the thing that's uniting it all is this potential to do it all better. But at the end of the day, you can't do it better if the rules aren't written that way. And that's what this next 9 months is all about. And getting involved and helping to understand it, take away what matters to you and help shape.
Welcome to RegCast.
RegCast.
Shining a light on challenges and opportunities for digital compliance.
Hello, everybody. Welcome. I'm PJ, CEO and founder of JWG, and I am really pleased to be hosting the third episode of season 2 of RegCast. There are a phenomenal number of moving parts in the whole digital asset arena, and we have got some really expert speakers with us today to help unravel what's going on with digital asset trading. We have an event coming up in the 5th of April that you'll be able to hear much more from these panelists on. What I would like to do today is really just introduce a little bit of the background on digital assets, which we've covered earlier in the season. And then we'll go right into two questions for our speakers. One is really what are the top compliance challenges, and then what they would like to hear at the conference. But the background is what are the digital asset regulatory frameworks are finally starting to move. We've had an asset class that's grown from nothing to $3 trillion. Finally, we have a presidential order in the US, which came out this month. We now have the UK, US, and Europe potentially moving in the next 9-month window to really figure out what their policies are in parallel. And that's really going to be great, because key to this debate is the regulatory performance within the system overall. So the general thinking with these asset classes is that compliance needs to be just as good as traditional finance, or what we call TradFi now. The catch is that TradFi compliance is really hard, and it's never been easy to digitize. And it's really interesting for us to see a whole new asset class come in and say, this is how we're meant to do compliance. But yes, there are plenty of lessons to be learned between TradFi and digital. And I think one of the key things that we're trying to get to is, well, what are these intersections between those two rails, and how do we connect them in a much better, faster, interoperable way? So without further ado, let me ask our panelists to introduce themselves, starting with Steffane, please.
Hi, good afternoon, and thank you for the invitation, PJ. Glad to be here. My name is Steffane Malray. I'm the head of market structure and innovation of ING Bank. I work a lot with regulatory topics with policymakers, regulators, central banks to try to help our organization move forward.
Thanks, Steffane. Brian.
Hi, I'm Brian from ADGM. I head up the data governance and strategy unit practice inside the fintech unit at ADGM. And what I do is I work with regulatory frameworks to define the appropriate types of policies that help foster growth in the fintech ecosystem. Prior to being at ADGM, I was in the Smart Nation and Digital Government Office in Singapore, working on the government data architecture. And before that, I used to look at data analytics as well as financial stability monitoring at the Monetary Authority of Singapore.
Thanks, Brian. And last but not least, Chris.
Hello, thanks very much, PJ, for having me here today. My name is Chris Q. Smith. I'm the Chief Compliance Officer, MLRO, and Data Protection Officer of Zodio Custody, which is Standard Chartered Bank's crypto subsidiary. Prior to that, I was with the UK FCA and also the ADGM's regulator.
Fantastic. Thank you all. The first question is really a simple one, but really hard in this case. What are the top challenges that compliance faces with digital assets? And Brian, I'd like to come to you first. From the customer's perspective, you know, this could be seen as a whole new thing outside the financial system, but really it's not. How do you make digital assets safe?
So I think let's take a step back and think about the current composition of users of digital assets, right? At present, I think you can broadly characterize it as either well-informed, so they are users who have understood the technology, understand the risks, have prudent risk management practices, or they are yield prioritizing, which I think is may perhaps signal that they take more interest in the yields that can be generated via digital assets than necessarily the risk management that comes along with this. So in a universe of customers where you have well-informed and yield prioritizing, the sustainability of a market is probably not going to be prolonged. The reason for that is that you have well-informed customers will always be a minority of the total potential customer base that's out there. And yield prioritizing customers over time will find that a lack of attention to risk management is a catalyst for driving them out of the market. So for digital assets to succeed, I think one of the things that they need to do is to be able to outreach to a broader middle base of customers. And that is a set of customers who are not necessarily well informed, but also more conscious of risk. And you know, let's take a bit of thought process here. The acquisition of information is not free. It takes time to dig into financial services and understand what's happening. It takes even more time to dig into digital financial services because it has the added layer of technology. I think what we will see, and to some extent, what will make digital assets safer for customers is a rise in intermediation. Now, I don't expect this to necessarily be the same kind of intermediation that we see in traditional finance or TradFi. They may not necessarily be the same players. They may not necessarily function the same way. But I think we will increasingly see intermediaries come up who can provide some level of technical expertise that customers can work with, so that the customers can rely upon them, and at the same time provide an avenue for this broad middle to be able to tap upon the potential returns and benefits that digital assets can bring. So that I think.
So let me just understand, Brian. These intermediaries are new actors, new entrants we may not hear here in the market today.
So I would argue that there will be new intermediaries and new actors, but I suspect that a large proportion of TradFi firms will be able to make the transition because they have the resources to be able to pick up the expertise that's necessary to help in such intermediation. More importantly, they already have the background in understanding the types of conduct risk that happen when you are providing financial services. So the fact that Chris and Steffane here are representatives of TradFi banks, but have also working in the digital asset space, I think is a clear signal in this regard. The challenge of acquiring knowledge, the cost of acquiring knowledge, doesn't just apply to technology, but also applies to compliance. And it's not necessarily clear that a tech firm is better suited or is able to acquire compliance knowledge more cheaply than a large financial institution is able to acquire technological knowledge. But to come back to your question on what makes things safer, I think the one thing that intersects between these two that the single largest thing that is likely to make digital assets safer for consumers is a move away from anonymity. And the reason for that is that there are two key sets of risks that anonymity brings. Now, there's a legitimate reason to want to ensure that there's privacy in your transactions. But whether that reason outweighs these two potential drivers of risk is up for debate, and I would argue they don't. They are first, terrorist financing and sanctions. I think this is a key issue that needs to be resolved for digital assets to be able to go mainstream. It is very hard to justify the use of digital assets if they are used to facilitate, for example, the funding of a terrorist organization or the busting of sanctions. The concepts, I mean, it's a fairly difficult role to hold to say that my privacy overrides the physical safety of persons in other countries. So that's the first set, MLTF. But I think much more importantly, as far as the digital asset space goes, is the risk of fraud. And this anonymity is not necessarily the anonymity of the users of digital assets, but of the issuers or the participants or the facilitators of digital assets. So for example, if you look at the recent case in the DeFi space of Wonderland, where you have a former CFO of a fraudulent cryptocurrency exchange being able to raise a large sum of money from users because he is anonymous, right? I think the more such fraudulent activity happens, the more there will be a push for unmasking of anonymity. And I draw a distinction here between anonymity and pseudonymity. Anonymity means that you truly do not know who you are dealing with on the other side. There are no pointers to do so. Pseudonymity.
Thank you. I'd like to pick up on Steffane's reaction, because I think you threw the ball squarely at TradFi there, and implied that actually, from a conduct perspective, you know, the TradFi is going to digitize you take the digital rails and work out how to, you know, create a big intermediary junction for them. But Steffane, what's your perspective?
Yes, sorry. I think I agree, and will challenge Brian a bit as well. But no, what you said make a lot of sense, of course. But from what we see, it's those two worlds that are very separate for the moment, right? So it's true that you have a world of people who trade crypto today. They are less regulated. They can do more or less what they want, and you have an existing world which is highly regulated, very cautious of what they do, and to try to protect the interests of their customer at the heart. And if we don't, we get fined. So we really try to do it seriously from the TradFi point of view. And we saw that years ago with the retail FX. Retail FX was not regulated, and you had those people, you know, from their mobile phone who would start to trade crazy with crazy leverage retail FX products, where on the institutional side it was still very well organized. And you had to fix one way or the other, right? So the only way to fix the retail FX was to put some regulation framework around it to stop the leverage and to do that. And I think for me, those two worlds cannot continue to be separated. At some point, we need to bring them closer together and to try to understand, as you say, right? If you want to be safe and compliant on trading crypto asset, you have to have some guidance and regulation around it. And we start to see that because even the people who are on this side who trade crypto with retail clients, they want to touch the big money, and the big money is the institutional client base. And they will not be able to access that big pool of money until it's more regulated, right? And for us, it's the same thing. We'll not go jump on the other side until it's more regulated. So we are aligned, even if we are very different today, we are aligned in a way to say, well, if we want to make it safe and compliant for enhancing the market and make it more institutionalized, we need to deploy more regulation.
Yeah.
Yes,
PJ, go ahead.
Just let me clarify one thing on there. It would, what we saw in the FX market after some of the abuses that happened, where there was a lot of a push towards a code, common practices, everybody signing up, say, yeah, okay, we're going to do it this way.
Yes.
Do you think that same kind of push is what we're looking at happening in digital assets?
That's a good point. So in FX, you have two things. You have the spot FX market, which is a mean of payment, so cannot be regulated the same way as a derivative market, like a forward instrument, an FX option, an FX swaps, and those are regulated products. And so what we did as an industry since the financial crisis and the scandal in FX is we work very closely with central banks to create a global code of conduct for the FX market. And this was, I think, a great success because it put an emphasis about the principle of how, so it was not regulation, but it was high-level principle of how the FX market should work and highly adopted by the biggest FX player in the world, and with the support of the central banks. And in the crypto world, you start to see that you see some of the crypto training association try to organize a code of conduct as well to say, at least until we get some regulation, since we have nothing, we can set up a set of principles that we adopt to, and we can tell our clients, this is the principle we adopt to, and we share with the rest of the industry. So it's a great way to start, but I don't know if it's the only way to finish for the crypto world.
Thanks. Chris, please, I interrupted you.
No, I think there's some fantastic points made by Brian and Steffane just there. I'd like to pick up on a couple of them. So, with regards to common industry standards and voluntary codes, and I agree it's a great starting point, but I do not believe it's the end point. Not least because in contrast to the FX industry, a lot of the firms that worked on the code or codes around the world, they were regulated in some other respects, right? And they happen to have an FX business. Whereas here, what we're seeing is firms that are largely unregulated, that don't have a securities arm typically, right? And then creating a voluntary code. So the actors that you see, taking Steffane's example, the actors in both situations are different. In the FX code world, they were typically regulated firms in some respects, whereas in the crypto world, they're typically not. They are registered for AML purposes, but that's not quite the same as we all know. So I think that, and again, following on from some Steffane and Brian's points, I think that there's not only is there an educational initiative that has to be undertaken for the retail and this kind of middle ground that Brian was describing, but also for the institutions, right? So at Zodiac Custody, we have institutional only clients. And right now we're seeing an awful lot of interest from the asset management industry, as you can imagine. However, a lot of the regulators are not comfortable with things like spot physical Bitcoin ETFs, especially in the US, right? We haven't seen one yet. They're all futures based. And then in Europe, a lot of the regulators are saying UCITS, sorry, can't go near crypto, right? And the only way that they're going to get comfortable is with additional regulation and highly regulated firms getting into this space. We've also obviously seen some of the work in Basel around regulatory capital for banks that want to enter this market. So we are going in that direction. I think that one of the things that there are two main things that I think the industry would like to see as a whole, and then Steffane, please jump in. First of all, a certain amount of global harmonization, right? So lots of different countries, each kind of going their own way. You've got the US executive order in the US, you've got the MiCA in Europe, and you've got consultation on stablecoins in the UK, right? There isn't yet a supranational body like the FSB or IOSCO equivalent for crypto assets. And this will result in a quite challenging patchwork quilt of regulation in crypto if we're not careful. And the second point I'd like to make is around ensuring that level playing field, right? So you have the highly regulated firms on the one hand, like the banks and the securities, the MTFs and ATSs and so on and so forth. And you have the crypto actors that are typically less regulated. There really needs to be a leveling of that playing field so that everyone can compete in a, in what is a fair and competitive market.
And that's a great point, Chris. What, in terms of leveling that playing field, tell us what you really think the opportunity is from having all the data on the chain, and what does that mean from a compliance point of view with the digital assets, and does it actually give you an advantage over the TradFi?
I think in certain circumstances, it certainly could. I think we'd have to be very cautious around which data to put on chain. So I mentioned I'm a data protection officer. So obviously anything that is personal, any sort of personal identifiable information will be very, I think that we should probably stay away from that being on chain unless it is permissioned in some incredibly robust way. Where I think, and what we've actually already seen, in fact, just this week, Chainalysis had a press release where they were saying that they're creating an oracle for sanction screening, particularly given the current Russian context, right? And that will enable smart contracts to be able to call what is essentially a sanctions list on chain. Right, which I think is incredible. So you could structure all sorts of quite powerful platforms and tools and products using smart contracts, but with some of the compliance aspects built in. I think it's still quite early days, but seeing these sorts of oracles come out from the likes of Chainalysis as an example is incredibly interesting to someone like myself who is also an MLRO.
Thanks very much. I think there's a great opportunity for upside here that I don't want to lose sight of. But I think in joining the two, that can help the TradFi discussion as well. And I guess this then gets me to the thinking about the event, and just it's amazing, but we have less than 10 minutes left. You know, Brian, the question is, why should people want to show up and listen to you on the panels? What do you think they'll learn about the future of this intermediated DeFi world that you're talking about?
So I think there's a couple of things. First, we think that DeFi is going to become more intermediated in the coming years, which sounds like an oxymoron, but it isn't. It's just where the decentralization sits, whether it's in the organization or in the services. The second reason is to talk about whether or not decentralized organizations actually are so decentralized. And it's not immediately clear to us when we look at the specifics of how a DAO works, that you can ever have a truly decentralized autonomous organization. If you're a software developer, you know that any kind of non-trivial code needs somebody to maintain it or it stops working. So as long as you have software that exists in the real world, somebody's got to be maintaining that. And I'm not sure that you can decentralize that somebody.
It's an excellent point, and one that gets brought to mind when you start thinking about DAOs buying football teams, and like how can you have 4 billion in wealth manage the selection of the play on the field, and what does it mean for the selection of the head coach? You know, there are all kinds of really gnarly governance issues around all of that, and you're right, they're gonna last for a long time. I'm really looking forward to digging into that one a little bit at the conference as well. Steffane, from your perspective, lots here to be thinking about. What's the big takeaway from the conference that you're looking for around the future of regulatory certainty?
Yeah, I think where we come from and where we are going, and that's, I think that's what I want to see at the conference, where a few years ago there was still a bit of doubt to say, is crypto going to survive? Is it going to go to zero? Is the technology safe? And now I think we passed that point. So people are more interested to know this is going to happen and how do I get involved in that? And going to those type of conference will help them to understand as soon as the regulatory certainty will happen, and I'm pretty sure it will happen, then their business will be impacted from it, from whatever they are doing. So the sooner you learn about it, the better prepared you will be for it.
Yeah, I completely take your point. And that's for those of you who haven't been through one of these periods in the industry. Unfortunately, my gray hair has taken me through a couple now. When the US declares they're going to move in 180 days, they move in 180 days. And you can't fathom that from watching the European Commission, because there's 5-year plans, and it's a battle tanker that turns very, very slowly. But the U.S. can turn on a dime. And that's really exciting, I think, from this market's point of view, because whole new ways of thinking about this will be, there in draft law by the end of the year. And that's you're absolutely right. Those eyes got to be wide open right now. Chris, what's going to be most interesting from your perspective?
So I think that what we're seeing come into play slowly is the introduction of market conduct rules on crypto assets, right? And that's going to be incredibly interesting, but also I think incredibly challenging for firms that are not used to it, right? So if you imagine what happens back in 2012, 13, and Dodd-Frank and EMIR were kind of competing to keep releasing their technical standards, I can see that sort of thing happening again in respect of crypto assets. Well, exactly as you say, PJ, you see the US moving typically a bit faster, and Dodd-Frank was a great example. And we may see the same thing here as well. And so I think that's going to be incredibly exciting to manage from a compliance point of view. I'm also hopeful, to one of your earlier points, that we should theoretically be able to do it a bit more efficiently this time, right? Because first of all, we have the benefit of hindsight, and second of all, we have a much more technology-driven industry. And so I'd hope that the tooling will be there to help us meet this future onslaught of regulation.
That's a very, very positive note, and I welcome that and echo it. And I guess to sum up from my point of view, that this is a really fascinating time for both the techies, the new asset players, and traditional finance. And the thing that's uniting it all is this potential to do it all better. But at the end of the day, you can't do it better if the rules aren't written that way. And that's what this next 9 months is all about. And getting involved and helping to understand it, take away what matters to you and help shape it. I think that's the nature of this RegTech dialogue is very collaborative by definition. And that's the opportunity we have in front of us is let's help everybody understand the way we think it ought to be done. So without further ado, gentlemen, thank you very, very much for your perspectives. It's been great speaking to you and a pleasure to host this discussion. Look forward to speaking to you all soon. And if you haven't found the conference yet, please go ahead and go to the JWG website, which will see you up for in a second. Take care. Bye-bye.
You can download the podcast via Spotify, Apple, and Google. But also I'd encourage people to come to the JWG website, which, as hopefully you will know, is jwg-it.eu. Go to the Intelligence Hub and create your bespoke library. This is RegCast.
Shining a light on challenges and opportunities for digital compliance.